Hi guys, welcome back to the channel. My name is Dave, and today I want to talk about QDPL. This comes to us from Pacer ETFs. That's the same group that brought us the triple leveraged Ozempic ETF known as COWS. All right, a good time to put my disclaimer down here right now. Not financial advice, because that was a dirty, dirty lie. That's not what COWS is about. But we are going to talk about QDPL because Chip keeps bothering me about QDPL. Why? Because it is an interesting product. So whenever I get these requests, especially if there's like 6 of them, then I add it to my list, and eventually I like to review it because I like to reward those that come along for the ride here at Wealth Adventures. So today we're talking QDPL. If that is what you're looking for, please stick around. So before we do jump into QDPL COWS, it's a real thing. It's the Pacer US Cash Cows 100 ETF. It's a 5-star Morningstar rating, and it is probably their most popular ETF. So you can check this one out as well if you're not familiar with Pacer ETFs. So yeah, that's COWS. It is a real thing, but we're focused on QDPL, which is quadruple the dividends of the S&P 500. So this one's been around now for a little over 3 years, and the performance has been pretty good. And if you're an income investor and you're looking for a little bit more than the S&P 500 offers you, this might be a good option. Someone that's looking for growth and some income. So as they say here, a strategy-driven exchange-traded fund, that's an ETF, my friends, that aims to provide cash distributions equal to 400% of the S&P 500 ordinary yield in exchange for modestly lower exposure, about 85 to 89% to the S&P 500 index performance. It's a 4-star. And yeah, as of 9/19/2024, they've got about $500 million of net assets under management. And my belief here is that this could be like a $5 billion ETF if they just cut these expenses back. So during my research, looking into this thing, this was brought up time and time again, that this is not an overly complicated fund. And I think they're charging a little bit more, 60 basis points. So I think some people that are conscientious of that expense ratio might shy away from this product. So manager out there at Pacer ETFs, you might just cut that back a little bit more. I know it was a little bit higher at one point. Now it's down to 60 basis points. I think if they could get this down to that 30 to 40 basis points, I think you're going to see a nice big spike as far as people that are going to be putting their money into this in lieu of just buying the S&P 500. Now let's take a quick look at their strategy overview. And one of the reasons that I think 60 basis points is a little steep is because a lot of this is just buying the S&P 500. So if you gave them $100, they're going to take about $89 of that, and they're going to stick it in the S&P 500. They're going to buy IVV, VOO, or SPY. But in this case, they're replicating the index within here. So just like those products. So they're going to all 500 of those stocks that are in the S&P 500. Then on top of that, with the remaining 11, 12, 15%, depending on what it's at that time, cash treasuries utilized to purchase additional dividend payments. So what they are dividend futures contracts, and we'll get into a little bit more of this, but that will give you essentially what equates to a distribution in the amount of about 4 times that of the S&P 500. So the S&P 500 right now is about 1.2 or 1.25%. So this is going to be right around 5. Right now it's doing distribution yield as of 6/30/24 is 5.79%. So the dividend yield for the S&P 500 right now is really low. It's about the lowest it's been. You know, I remember first trading when I was very young, and somebody told me if the dividend rate of the S&P 500 is above 2%, you're a buyer. Go buy. If it's at 1.5 to 2, consider buying. Just continue to like dollar cost average in at that moment. If it falls below 1.5, you might be overvalued. You might be backing off. Now, I'm not saying that's what we're in right now, or the conditions that we're in right now, but it's definitely very low right now. And so that 5.79% is relatively low for what I think you'll get in this fund too over time. So I think it'll be in there between 5 and 7% historically as we move forward. We'll kind of see where that plays out. But that's the idea. They're going to be putting this in the S&P 500, and then they're going to be buying dividend futures contracts with the rest of this, which can give you outsized returns versus the S&P 500, as we will see. And that is the strategy. So 60 basis points, again, I think is a little bit steep for what they're actually doing here, because those dividend futures contracts, they do that once a year in December, and they go out 3 years. And then at the end of that year, they're going to roll to the next one. So not overly complicated. So from the Pacer website, you can download all the holdings of QDPL. And what you're going to find is, just like they said, about 88, 89% of this fund is just the S&P 500. All those individual stocks of the S&P 500 at the proper weighting equal to 89% of the fund, with the balance being these index futures contracts. You can see the three of them here. They expire in December each year. So we have 2024, 2025, and 2026. And you can see the weighting over here to the right. And the futures themselves, which you can see here, go out to 2026. They're simply a bet on the expected level of dividends in the future versus what is current. Now, I wanted to find something that people could relate to if they're not really familiar with futures. So I found this at dividend.com, and I thought it explained it pretty well. You can read through it, but I want to focus here on the part down here where it says, according to S&P, by isolating the dividend from the stock, which that's what this is all about, investors have been able to score an annualized 6.71% return over the last decade. That's not too shabby at all and underscores how powerful dividends are to total returns. So I think the important thing here is to understand that these dividend futures contracts can give you outsized returns versus the S&P 500. So it may give you something much larger than 6.71% one year, but there might also be years where they cut the dividend and you have a retraction in the overall dividend amount and you lose on these trades. However, because we're doing it across a 3-year period, most instances I would expect a positive return out of those 3 years, and you just don't know how positive that will be or if it will be outsized versus just owning the S&P 500. Now we can take a real quick look at the dividend yield. In this case, it's the trailing 12 months for QDPL, and right now it's sitting right at 5.51%. I'd expect it to kind of stay in that 5 to 7.5%, right around 4 times that of the S&P 500. So I think the S&P 500 is right now around 1.25%, so it's pretty darn low relative to where it's been historically. Now, I know I've mentioned it plenty of times before, but I am a Seeking Alpha affiliate. There are affiliate links down below if you're looking for a stock and ETF research tool. But when it comes to products like QDPL, I haven't found any place that has better coverage than Seeking Alpha. So, for example, if you're trying to find information on taxes related to QDPL, that's where I would go to find that information typically. So you might also find it in the prospectus, and it should all be spelled out there. But a lot of times these are summarized better. In this case, I'm looking at John here, John Bowman. And he did a review of this. And there's a lot of reviews actually on Seeking Alpha. So again, I find that it's money well spent for myself. So it's one of the reasons I talk about it, one of the reasons that I utilize it. So if you're looking for a tax-efficient product, this might be right up your alley. So we're looking at ex-dividend dates for 2023 over here on the left, and total distributed amount here in the middle. And you can see that a small portion of that is ordinary income, and a large portion is return of capital. So depending on your view of return of capital, where you are, this could be a very tax-efficient product for you, where a large portion of it is coming back and you're not going to be paying taxes on it. So if you're in your peak earning years or you're an income investor looking for something tax-efficient at this point in your life, that's one of the perks of QDPL. It could perform very well for those looking for a nice stream of income that's not going to be taxed very heavily. So now let's take a look at what really matters, and that's performance. So QDPL has been out for over 3 years, which is a nice thing. A lot of these covered call ETFs haven't been out that long, so it's hard to look at historical performance. At least with this product, we have 3 years of performance data to look back on. So if I'm just looking at price return only, forgetting about the dividends, and we compare it to a couple other products that have been out that long, namely VOO, which is the S&P 500, very popular, and JEPI, a covered call ETF that's been around for a little while. We can see that we've got 10% from QDPL over the last 3 years. And let's remember, 2022 was not a good year for the stock market in general. 2023 was a very good year. 2024 is shaping up to be a very nice year as well. VOO up 30%, so triple. And JEPI losing 2% over the last 3 years. But if we feed back all those dividends, then what do we get? Distributions, I should say. Then we get total return. So with Seeking Alpha, all you got to do is hit select metrics, get rid of price return, look at performance, say total return, and update our chart. We can kind of see how they compare when you also allow for all those distributions to be accounted in these returns. Then you're going to see that QDPL pretty respectable at about 33%. not too far off the pace by about 4% of the S&P 500. You still get that better return, and perhaps that's the fee difference, right? That's really affecting that. And then with JEPI, you actually have a pretty decent return also of 28% over the last 3 years. So respectable, all of them. But you kind of see QDPL kind of fits right in the middle when we just look at total return for these three products. And let's do one more comparison and look at a 1-year chart, total return, and compare to some other products that you might compare this to if you are an income investor. So QDPL total return 1 year, 28%, pretty darn good. VOO, 31%. We just cut rates by 50 basis points, so we do want to get long some equities. But if you don't want to buy the straight S&P 500, you want to use covered call strategies or something like QDPL. I think it's still time to start activating money. Again, not financial advice, but I am moving out of cash. I'm getting long with some equities. I'm buying some more income products. JEPI there at 16%, not too bad. SPYI 19.4%, not too bad. Devo doing 20.5%. When I say not too bad, I'm saying not too bad compared to the S&P 500. I'll take all of these. And then XYLD 14.6%. I'm not really a fan of this family. You've probably heard. But yeah, QDPL is doing quite well when you look at the total return. It's just trailing the market, but it's doing pretty well compared to some of these other income products. So let's play a little like, don't like. What do I like about this fund? Well, what I like most of all is it's not a covered call ETF. It's a different strategy. It's uncapped, so it's allowed to grow. At least 89% of it is. So when we have big moves like we had Thursday after a 50-point rate cut, you're not going to cap your upside. So it's allowed to grow. And you need some of that in your portfolio, things that don't correlate if you just have a bunch of covered call ETFs. So it's a little bit different. I like that, and that might work really well for somebody. Yes, it's not 10, 12% like you're getting distributed from some of those funds, but that's okay because it offers that growth. And you can see that total return was actually better. So it might be time to add a little bit of QDPL if that's your situation. Second thing that I like here is the tax efficiency. So if I'm getting those distributions and I'm in a position where I don't want to pay heavy taxes right now and I'll push those off to a later date, this might be a good fund for me to consider as well. So getting 5 to 6%, maybe even 7% at times off of this fund sounds pretty attractive if I get to keep the majority of that because the rest of it, the majority of it is return of capital. So that might work out really well for some investors. I know I would find that attractive right now if I wanted the extra income. What I don't really like, though, is the fee associated with this. So 60 basis points seems pretty steep for this strategy. If you're the fund manager and you're watching this right now, if you can find a way to reduce that, I truly think that you're going to take something that's, I think, was like 50 million of assets under management, and it could grow substantially larger, and maybe you could offset that. Maybe you'd make a lot more. What do you think about that idea? So who should consider this ETF? Well, I think if you're an income investor that's heavily into covered call ETFs and other income schemes, that you might look at something like QDPL as well to get that extra little bit of income and that tax efficiency. So again, SPYI uses the same strategy, right? 1256 contracts and return of capital. Combine that with this. Combine that with an MLP, something that gives you a K1, and a lot of it is a return of capital, tax efficiency. Wow, that looks pretty good, especially if you're in your peak earning years, but then maybe you don't want income anyway. But if that's your plan of attack, then this is a pretty good one to consider. So it is for income investors. I wouldn't say if I was 25 years old, I'm not buying this. If I'm 55, 65, then I'm definitely shopping around for QDPL, especially if we can get that 60 basis points. I won't say it again, but you get the point. So for me, buy, don't buy, I'm on the fence. I'm on the fence with this one. Like, do I need this in my portfolio right now? Or should I just continue to buy the S&P 500? So let me know what you think about QDPL down below. Do you own this one? Is it a buy or don't buy? I'd love to hear from you. And if you have any questions, ask down below. Like and subscribe if you like this type of content. And we will see you next time. Have a great night.